Hello and welcome to the third video of the third course where we are discussing investing. Thank you for being here. Thank you for taking the time to watch this. And I hope by the end of this video that we have a little bit more understanding of the investment options that you have access to. Because that's really what we're going to talk about today. We're really going to talk about the investment options, and because we need to understand what the investment options is in order to figure out sort of how we're allocating and how we're actually going about investing. And so today I'm going to dive into that. But before we get started, make sure to sign up for that newsletter. I'm at YouTube Thinking Solo, LinkedIn, my name, and of course share this course because we're trying to build wealth. We're trying to build wealth as a group, as a community, and the more we share, the more that people can learn these things and grow as well. Okay. So what are we talking about today? So this is going to be a very educational focused video because we're really going to talk about the nuts and bolts of stocks, bonds, mutual funds, ETFs. As always, this is for education purposes only. This is not targeted advice, but no matter how you are investing or saving, you need to know what these things are because these are really the options that you're going to be using and choosing between in order to put your money to work and grow for the long term, which is really why we're investing in the first place. So I'm going to go through what a stock is, a bond is, what a mutual fund is, what an ETF is, or an exchange traded fund, and talk about a few other things that's available as well, since when we're talking about investing, there's a huge world of investing, but we're going to talk about the main things that we sort of come across and where most of your focus is going to be. And the reason this is important is because when we're picking assets, and by assets I mean the stocks or bonds that we're investing in, or mutual funds or ETFs, what we're doing is essentially choosing the amount of risk that we're taking on. And so if we don't know what the tools are that we're investing in, then we don't know how much risk we're going to have. And we may have so much more risk than we really want, or not nearly enough risk that we need if we don't properly understand these concepts. And so it's important to understand what these things are, just so you can understand, you can kind of grasp like how you're investing and why you're investing and why said mutual fund is in X account or X stocks or X bonds. So you have an understanding of what that means for you and your long-term returns. And so we'll start with stocks first. So what is a stock? You probably know this, like a stock, when you buy a stock on a brokerage like Fidelity or Vanguard or wherever, Robinhood even, what you're doing is you're buying ownership in that company. And so one stock is one share or one vote, and the two are equal. And so essentially by investing in the stock, what you're doing is you are betting on that company. Betting is kind of a loose term, since we think of like betting as like a big win or big loss. But in reality, you're just kind of putting your money on the line, thinking that company is going to perform better than it is today. And because of that, the stock price will go up. And that stock price theoretically is supposed to be impacted by the amount of profits the company brings in, or revenues, or the lack of expenses, or something exterior to it. But also because these companies share on a stock exchange where people can take quote unquote bets on the company, other factors can play a role, like enthusiasm for a company, lack of enthusiasm for a company. And so these things can play into that stock ownership, because if a stock becomes something that every investor really suddenly wants, even if the financials don't necessarily hold up to that reality, the price will rise because the demand for that stock rises. And by demand, I mean like when it's selling on a third party exchange. That may not have anything to do with the company, right? Theoretically, when you're investing in a stock, it should be based on what the company is doing. But we know through like years and years of downfalls and upturns within stocks, like that's not always the case. You can just look at the .com era to see that. But if you understand that sort of basic premise that the stock is supposed to be a representative, like the stock price is supposed to be representative of the company's value, then you can kind of get a sense of what you're buying when you're buying that stock, because you're buying a small portion of that company's value. Now, one thing that stocks or companies that have stocks do in order to encourage more investors and support is pay dividends. And what a dividend really is them taking their earnings that they've made, so the profits that they've made, and giving it back to investors. And they're saying, hey, we did great this year, let's give it back to investors. And so some people really like to invest deeply into dividend paying stocks. But you have to also realize what's happening when a dividend is being paid. Essentially, what they're doing is taking earnings and giving it to investors. But earnings is a big part of what the stock price is. So theoretically, when you receive dividends, the stock price is going to drop by the amount of the dividend. That's not always the case, because again, there's third-party reasons why a stock price exists the way it does. But in theory, that's how it's supposed to work. And so because of that, it's not always good to have dividends paid out of a company. In fact, there's a big difference between what's called value companies and growth companies. Value companies are companies that pay a lot of dividends. Growth companies are ones that pay hardly any dividends. And that's because they think it's far better for them to invest the money that they're earning back into the same company, because they're creating so much growth, revenue growth, earnings growth, that will then encourage that stock price to continue to rise. The dividend paying stock may be an older company that doesn't expect like these huge growth figures year on year out, and so they're going to pay more to investors to encourage them to stay. Both are valuable within a portfolio, but that's the difference. And just because a company is paying dividends doesn't mean that suddenly it's a better investment than, say, a company that's not. It just really depends, because you also have to evaluate what's happening to that stock price. Next, we're going to move on to bonds. So a bond is essentially a loan. And we all know the experience of a loan, right? We have mortgages, or we have credit card debt, or whatever. And essentially that is the bank saying, hey, we're going to give you this money, you're going to pay us back for the money, but we're also going to charge you interest for lending it to you, and so you're going to pay back that loan with interest. A bond is essentially the same thing, except instead of you borrowing money, you're giving the money over as a loan. And you can do this by giving it to government, so government loans, or government bonds, that is. Or you can do this to a company, or that's via corporate bonds. Or you can do it to the state or a municipality that you live in, or wherever. They will release bonds as they're raising money locally to encourage maybe building a new bridge or something like that. And so that would also constitute, what is a bond, or essentially a loan. And so when you pay into a bond, what you're going to get back is a certain amount of interest on that loan. And typically you'll get it back every quarter or every year, depending on the terms of the bond. And after a certain amount of time, say 5 years, 10 years, then you receive the principal, or the amount that you put in, back. And so by the time the bond has matured, you've received both the interest throughout the years, as well as the principal, or the amount that you initially invested. This sounds great because it sounds like risk-free, right? You give the government money, you get interest back, and nothing's ever going to happen to that. It's not really the way it works, because let's say you're doing corporate bonds. Some corporate bonds are really bad investments, because the company's never going to be able to pay you back, and you won't necessarily be the first person to get paid back when creditors and whatnot come to collect. That's one reason. The other reason is maybe the growth of interest that you're getting from the interest isn't nearly as strong as, say, the growth that you could have received in the stock market, or even faster than inflation. So both of those situations would be pretty concerning. The stock market, that's just showing the opportunity cost lost by investing in the bonds. And then inflation, if you're not growing faster than inflation, well, that's going to be a real problem for you down the line. And so when you're thinking about bonds, you have to think about sort of what the interest that you're receiving and how that plays into your overall portfolio, but also how that plays with inflation. And so what will happen is you may have bonds that, let's say you had bonds that you bought when interest rates were very, very low. You're probably not getting paid a lot for that bond because they could have gone someplace else to borrow the money if you were going to charge too much of interest. So now interest rates are high. It's going to be nearly impossible to sell that bond at the price that you got it. So you kind of have to hold on to it. Meanwhile, you could have had this other bond that's getting paid a lot more. And so this is kind of the analysis that's being weighed when you're investing in bonds. And if someone's investing in individual bonds, that becomes really problematic. Of course, most people do not invest in individual bonds like that. Instead, they're buying mutual funds or ETFs that hold bonds, so that that works a little differently, which we're going to talk about in a minute. But in theory or in the concept, that's how it works when you're investing in a bond. And so let's talk about mutual funds next, since that's really how most people are investing in some type of mutual fund or ETF. And so a mutual fund is essentially a mix of stocks and bonds. When we are investing, we want to diversify. Yet for most investors, let's say you have $5,000 to invest. It's going to be really hard to buy 100 different stocks or 100 different bonds with just $5,000. Instead, what mutual funds do is say, hey, we can create that diversification, sell you a portion of the mutual fund, and now you have diversification in 100 stocks or 100 bonds or 500 stocks, 500 bonds, whatever. And so it creates that diversification without having to do it individually yourself. But mutual funds in particular work a lot different than stocks or ETFs or anything like that. And that's because they aren't traded like stock. Instead, when you decide to say, I want to sell this mutual fund, you announce that you want to sell it, and that's tracked, but nothing happens till the end of the trading day. So at 4 o'clock Eastern, when the markets close, that's when the mutual fund will receive notice that you want to sell your shares, and at that point, the shares will be sold. But that also means that the price of that mutual fund isn't priced until the end of the day. So if you set to sell at the beginning of the day when the mutual fund was, say, $15, and now it's $10 at the end of the day, well, you're going to sell it for $10. You're not going to sell it for $15. And you have no control over that. It's just the way it sort of operates and the way investors have to deal with mutual funds. And internally within the mutual fund, you don't have control over what they're doing. I mean, you can decide to divest or something like that, and they're going to announce kind of their style of investing or how it's being invested, whether it's an active investor or a passive investor, which I'll get to shortly. But what actually happens in that mix, you have no control over. It's not something that you're going to get to say like, hey, I'd rather you look into this company or this company, whatever. They're just not going to let you do that. And there's no control of taxes because they are going to be selling stocks and bonds throughout the course of the year, and that will flow to you. You will get those returns, and you will have to pay taxes on that. That could be a real problem if you are in a taxable investment account where you are having to pay taxes on a year in, year out basis. So it's something to think about. And it's also why another tool kind of grew into existence is because of all these complications with a mutual fund. And that is the exchange traded fund. An exchange traded fund is essentially like a mutual fund. So it's a mix of stocks and bonds, a large group that you can get access to, right? But it trades like a stock. So that it's priced on the market, and you can sell immediately and buy pretty much immediately as long as there's a buyer and a seller for that ETF. And so it trades exactly like stocks. This has a lot of benefits because one, if the ETF is buying or selling stocks and bonds internally, it doesn't flow to you. So you're not necessarily paying taxes on that if, say, you're in a taxable account and you're not getting dividends. It also means that you can kind of control when you're taking capital gains. It can control what price you are selling at and all those sorts of things. And so it kind of works like a stock in that way, which is really, really nice. And frankly, ETFs is the way that I trade and buy for most of my clients at any time, because they're just much easier to get in and get out of and to control now that they exist. And a mutual fund will have a mutual fund share as well as an ETF. So it's the same exact thing. It's just you can buy it as an ETF. And so if it's the same exact thing, I'd rather typically buy it as the ETF. But mutual funds and ETFs also have an aspect to them that stocks and bonds don't, in that you can either choose whether they invest actively or passively. If you know what an index fund is, that's what a passive investment is. An active investment is one that has an active investor. So there is a live human making investment decisions on a day in, day out basis. They may say, hey, we invest the majority of the investments in U.S. middle-sized companies. But if they see an opportunity in a large company or a small company, they may also take that. And you have no control over that. That is not within the realm of control if you're investing in that mutual fund or ETF. They're often trying to beat the market. So if the market returns 6%, they want to return 7, 8, 9, 10%. When you're evaluating that, you need to make sure that you're evaluating the market that they're investing in, and whether it's actually beating that market. Because what a lot of active investors will do is say, hey, look at this, we're outperforming the S&P 500, but they're invested in small cap or small companies, and small companies performed really well this year. And if you just look at a small passive index fund, you'll realize maybe it didn't outperform that mutual fund or ETF. And so you have to compare apples to apples when comparing these. But in essence, they're saying they try to beat the market. But because there's a live human actually making investment decisions, that means there's a whole team behind that person doing research, figuring out where to invest and whatnot. And so it's higher fees because of it. Passive investing is where it's just an index fund, and they're saying, hey, we're going to invest in the S&P 500, the 500 largest U.S. stocks, and we're not going to make any decisions. We're just trying to mimic that. And as long as those 500 stocks move forward over the course of the year, we're going to move forward. If they move back, we're going to move back, but we're not going to change like the dynamic in the ETF or anything like that. And there's passive index funds for small companies, middle-sized companies, international companies, emerging markets, anything you can really think of. There's also passive versions of it. And so there's no investor decisions. They're just trying to match the market. And because of that, there's a lot lower fees. In fact, fees for index funds have grown so low, and the funds have become so popular that it's forced active investors to reduce their fees, only to entice investors to invest with them. And I will say, again, this is not individual advice. I am a passive fund investor. I look for broad-based, low-fee funds, and that's how I invest for my clients, just as an FYI. Some other options to think about as you're looking into your investing experience for the first time is there's other areas of the market that you could put money in. Now, the more you put into small areas of the market, the more you're potentially taking active decisions. Because if you say, hey, the U.S. market is made up of let's just say 6% of real estate, but you're putting 10% of real estate, you've taken an active decision. You're saying, I believe real estate is going to outperform more than it currently is right now. And so you're overextended in real estate. And maybe you want to be, but you just have to be aware of that. And so often when we say real estate, what we mean is real estate investment trusts. So these are tools that take real estate products, bundle them together, and now you have access to the investment tool, which is invested in the real estate products. You can find the same stuff, mutual funds, ETFs, passive investments, aggressive investments in precious metals. There's cryptocurrencies. There's even fund like passive funds for crypto now. So, it's mostly geared around Bitcoin, to be honest. So it's not like as dynamic as the other markets at this point, but it is possible. And, I have clients who have a very large exposure to cryptocurrency. It doesn't seem to be going away at this point. It's just the more you're going into these things, the more you're taking a risk that you could lose that money, because these are much more untraditional sort of investments. And same with alternatives, which are like, it could be like a hedge fund, or it could be like a number of different sort of alternative investment vehicles, which use like financial mechanisms to try and weed out gains from the market. And there's ways that a normal investor can get access to them, although they're not like the most efficient or effective or anything like that, but they do exist. And it's worth knowing about if you're looking into investing for the first time. Hopefully this helps for today. That gives you a good rundown of what we are talking about when we're investing, and the tools that we're using or the assets that we're using or tools that we're using to invest in. And in the next video, we'll actually talk about how we're going to take those tools or those assets and create our allocation. So match the assets to our needs and get on our way to actually investing for real. Make sure to join that newsletter, and then watch out for the next video, which is determining your asset allocation. I'll speak to you soon. I'm Thinking Cap Financial, and have a good one. Let's go.